Shit. Ay, şey. मैं गंगा बता रही हूँ
Okay, hi everyone, guys. Good morning.
Good morning, sir.
Good morning. Let's start with the remaining topics of cash equities. Then we'll move on to money market. Guys, I just want to check: have you got the chance to go through the introduction to financial system, cash equities, and fixed income, whatever we have discussed so far?
Yes, sir.
Both of you. Okay, and very soon you are going to have your Viva also. Okay, and in Viva I am going to ask questions from everyone. Okay, all right, so let's continue with what was left in cash equities. So next we have authorized number of shares issued and outstanding shares. Whenever a company is established, they need to register their shares with the regulator. Okay, so they need to register the shares with the SEBI. We call it shelf registration. Okay, the number of shares you have registered is the authorized number of shares. Okay, so what do we mean by this is that is the number of shares that the public traded company can issue as stated in its articles of association. Okay, so as per the law, this is the total number of shares that a publicly traded company can issue. Okay, if you want to issue more than that, then you need to get the registration done for those extra shares. Okay, there are a lot of formalities that need to be done for the shelf registration, but once it is done, then you can issue those shares anytime. Okay, so this is the total number of shares that can be issued by the public company. Okay, issued is the number of shares that are actually issued. Okay, so it might happen that you have 10,000 authorized shares. Okay, that means you can issue 10,000 shares. Issued as of now only, you have issued only 7,000 shares. Maybe you don't need so much funds right now that you would have to issue 10,000 shares. You need some funds, so you have issued 7,000 shares only. But later on, you can issue 3,000 more shares. Okay. Then you have some treasury shares. What are treasury shares? The shares which have been bought back after the issuance. Okay, so that means, let's say the company needed funds. Let's say company needed funds, so they issued some shares. But let's say after some time they had some surplus funds. So what they did, they bought back some shares. Okay, so let's suppose they bought back 1,000 shares. So we'll call them treasury shares. All right. The last is outstanding, guys. Outstanding would be what is outstanding in the market currently. Okay, so that would be issued minus treasury shares. So that would be 6,000. I hope you are clear with what it means, right?
Sir, authorized means also the nominal capital we can call.
Yeah. Not in the form of amount, in the form of shares. Okay.
Sir, authorized is the total number of shares that we have to register with the SEBI if we list it.
That are registered with the SEBI and that you can issue.
So out of 10,000 shares, if the if the company is listed in, so the issued is 7,000.
Yes, so these can be issued privately or publicly. Okay, this is the total number of shares that are issued with the owners, with the HNIs, everything. Okay.
Sir, if the company wants to issue the whole shares out of 10,000 to 10,000, so
Yeah,
what is the case of this?
yeah, they can issue that. If they need more funds, they can issue up to 10,000 shares. But if they want to issue more than 10,000 shares, then they need to do the self registration for the extra shares as well.
Sir, if they issue more then the promoter holding will be decreases, na sir?
That depends whom are they issuing it to. If they are issuing it to general public, obviously the promoter ownership will decrease percentage wise.
Okay, sir.
Sir, from where the treasury shares are bought back?
Sorry.
The treasury shares, you told that it is bought back.
Yeah.
So I didn't understand this.
In the market, the company can say that, okay, we are buying back the shares. So whoever wants to tender their shares, they can tender it. Okay. So what happens is, let's say the current market price of the share is 2,000 rupees. 1,000 rupees per share. So what will happen? Company will say that, okay, we are buying back the shares at 2050 per share. So if anybody gives back the shares, we'll give them 2050 per share.
Okay.
So whoever is holding the share,
Yes.
they can give the shares back to the company and they will get the cash. Okay.
Okay.
So
Thank you.
these are the shares that are bought back by the company as treasury shares.
So what is an outstanding share?
What is the outstanding share? Okay. Outstanding share is the share which are still outstanding in the market. Okay. So let's say they issued 7,000 shares, but 1,000 shares were bought back later on. So now only 6,000 shares are outstanding. Okay. So it is issued minus treasury shares.
Okay, sir.
All right. Next is the concept of depository receipt size. What are depository receipts? These are instruments which provide the opportunity for a domestic company to raise funds in the foreign country. Okay. These are the instruments which provide the opportunity for a domestic company to raise funds in the foreign country. Okay. For example, let's think about Infosys. Okay. Infosys is what? Indian company or what? It's an Indian company, right? Yes, I hope you know that. Yes or no? We have a very low participation today. Is everybody awake, having breakfast or what?
So doing breakfast.
Doing breakfast, huh? That's very honest of you. Okay, but guys,
So
I
still
hope
feeling
everybody.
sleepy.
Yeah, I can understand, man, but okay, let's not party every day. Please try to wake up early and be attentive, guys. Okay, let's say there is an Indian company which wants to raise funds in India. So it's very easy to to list the common shares in the market, right? So they will just go for IPO and they will list their common shares. They can easily raise funds in the Indian market by issuing the common shares through the way of IPO. Okay, but let's say Infosys wants to raise funds in America. How can this do? Any idea? Anybody heard of depository receipts? It can be done through depository receipts. Okay, so any domestic company which wants to raise funds in the foreign country, what they can do through the equity instruments, then they can issue depository receipts in that country. Okay, for example, Infosys has issued American depository receipts in the American market. Okay, so guys, how it works is Infosys, let's take this case. Okay. Infosys has authorized share capital of 10,000 shares and they have issued 7,000. So 3,000 is still with them, right? They can issue 3,000 more shares. Yeah. Now, rather than issuing those 3,000 shares in the Indian market, what they can do, they can transfer the 3,000 shares to the local custodian in India. What they would do, they would transfer the 3,000 shares to the local custodian in India. Let's say Stock Holding Corporation of India, any. What would SHCI do is it would transfer the shares to the global custodian in US, let's say. Guys, it can be a global custodian, it can be a local custodian of US, that's also fine. Okay. So they would send the shares to, let's say, DTC, which is also acting as a depository. So guys, please understand this as like this, okay? In US, you have a concept of that these two usually work together. In India, we have depositories working separately and custodians working separately. We don't have that bigger institutes which act as custodian and depository also. But in US, we have institutes which are acting as custodian and depository. Okay, so DTCC is one of them. So what would happen? The shares would be transferred to the DTCC in US. What would DTCC do is, they would issue depository receipts to investors against those shares. Okay, DTCC is having 3,000 shares. So what it has done is it has issued depository receipts to investors in the US now. Okay, so let's say there is a person C in US and he wants to invest in Infosys. So how can he do? He can buy the Infosys ADRs. Okay, American Depository Receipts of Infosys, which are issued by the depository of US. So that's how they can invest. And when they invest, the money that is going to come would go to the DTCC first. Then that money would be transferred to SHCI. That money would go to the Infosys. Okay. Please note it down, guys. If you have any questions, let me know.
Sir, I wanted to ask a question.
Yeah, please.
Sir, are the depository receipts attractive to the investors? Like, for
If you
example,
feel,
uh,
yeah, if
like
you
for,
feel Infosys is going to do well, depository receipt is just as attractive as equity share, right?
okay, but I like in America, there are better as their market is larger and better. So how will their Infosys compete over there?
No. See. Who would issue the depository receipts? Why would Infosys issue depository receipts in America? Only if they feel that there'll be demand. Only if they feel that Infosys is popular in US and investors want to invest in Infosys. There is a lot of demand for the services which Infosys provides. The future growth prospects are good. Only then they would like to buy. And Infosys, if the company feels that okay, we have a very good image in the US and we can raise funds from the US, then only they will go for DRs, right? American DRs.
Okay.
Sir, are these depository receipts also traded?
Yes. Okay. So Basically, there are sponsored ADRs and non-sponsored. Okay, non-sponsored would trade over the counter, whereas sponsored ADRs would be exchange traded. Okay, so just like you buy or sell the shares of any company of Infosys, let's say in the Indian market, similarly you can buy or sell Infosys ADRs in the US market. Okay.
And like how many DRs will be like issued against these 3,000 shares?
Okay. See guys, there will be a particular ratio. Okay. For example, it could be 1:1, it could be 2:1, it could be 5, anything. Okay. For example, you can say it could be 3 shares to 1 ADR. It could be like that. Okay. It could be like 2 shares. 1 share equal to 1 ADR. It could be 5 shares, 10 shares, any ratio could be there. Okay, because what happens is, let's say you have a price of rupees 200 per share in India. Say a company has a price of rupees 200 per share in India. Now, if they go for a ratio of 1 share is equal to 1 ADR, what would that mean? That would mean in dollars, they will have a price of how much? 200 divided by 75 equal to 2.75. Just check, guys. Okay, so that would just mean that the price is $2.75 per share. Okay, so maybe they don't want this does not look good. This is very low price, right? So maybe they would like to have a ratio of 2 shares or maybe 5 shares is equal to 1 ADR, so that their share price is 1000 upon 75 equal to around $13. Okay. You understood? So company would decide what they want exactly, so that it doesn't become a penny stock in American market. They don't want that. They want a decent dollar price also, so they might keep the ratio according to that. Are we clear?
Yes, sir.
Guys, what I want you to do, find out. Okay, let me tell you about sponsored and non-sponsored ADRs, guys. This was the case of a sponsored ADR. Okay, when the company is involved, company is getting the funds, that sponsored ADR, these would be listed on the exchange. Okay, and these would be traded on the exchange. Anybody can buy or sell them on the exchange. But what happens in unsponsored ADR is the company is not issuing the new shares. Okay, company will not get the money. Let's say a depository and a custodian bought shares from the secondary market. Okay, now when they bought shares from the secondary market, they can issue ADRs against them and they will get the money. Okay, they don't need to pass the money to Infosys. Infosys has not issued the new shares. It's the DTCC which bought the existing shares from the secondary market, and against the shares they have bought, they have issued the unsponsored ADRs. They will be traded on the counter, over the counter, not on the exchange. Okay, Here the company is not involved, company is not issuing the new shares, company will not get the money. It's the DTCC which bought some existing shares from the secondary market and issued the ADRs against them. So DTCC would get the money. DTCC is the owner of the shares. They would get the dividend. They would have the voting right and all. The investors in the unsponsored ADRs would not get any of those rights. Whereas if you invest in the sponsored ADRs, which are issued by the company itself, in that case, you get all the rights, okay? Dividends, voting rights, ownership, everything. But in unsponsored ADRs, you would not get that. And unsponsored ADRs would be traded over the counter, whereas sponsored ADRs would be traded on the exchange. Okay, please write it down, guys, if you have any questions. We call the depository receipts which are issued in America as ADRs. Similarly, guys, we have GDRs. Okay. When a company wants to raise capital from multiple countries, okay, not just America, but let's say from London, Hong Kong, Singapore and all, they can issue GDRs. Okay, these are global depositories. And similarly, we have IDRs, which are issued when a foreign company wants to raise funds in India. Okay? These are Indian depositories. Okay. Now, guys, can you give me some examples? Can you search and tell me which Indian companies have issued ADRs?
Larsen Toko Limited.
Dr. Reddy, ICICI Bank,
Reliance
HDFC.
Industries, State Bank of
Tata
India,
Motors.
Mahindra and Mahindra, Larsen and Toubro.
Okay, good, guys. So, yeah,
State Bank of India.
Sir, Vedanta, Tata Motors.
yeah. There are quite a few companies who have issued ADRs, guys. Okay. These would usually be uh, bigger companies with a popular name in the American market also. Basically, should be popular with the investors there, and then you can raise funds from them. Okay. All right. So that's about the depositories. So
Sir,
yeah,
as you said that in case of unsponsored ADRs,
Yeah.
the dividend will be earned by the DTCC and not by the
Absolutely.
investors.
absolutely.
So why will the investors, buy these ADRs if they're not getting?
Because what would happen is, let's say Infosys is doing well and unsponsored ADRs are issued, then what would happen? DTCC has issued the ADRs, right? If the value of the shares go up, it's going to benefit the DTCC, right? What they would do, they will pass on the benefits to the investors. Okay. Legally they are the owners of the dividends. Legally they would get the capital appreciation and all, but what they can do, they can pass on the benefits to the ADR investors. Okay, maybe they can pass on some of the dividends, maybe they can pass on capital appreciation. You understand?
Yes, sir.
Sir, in unsponsored area,
Hmm.
the return is from the Infosys group or the DTC which are traded in the US stock exchanges.
Sorry, can you repeat your question?
Sir, in case of unsponsored area,
Hmm.
sir, the investor who purchase the ADR in the US market, sir,
Hmm.
for the return they expect from the US stock exchange or the Infosys.
No, it is over the counter, okay? The party which has issued you the unsponsored ADR, they will give you the money. There is no exchange involved in the unsponsored ADRs. Okay? Got it, guys? That completes our cash equities, okay? I'll ask you some questions. You can try to answer those questions, okay? Guys, I'll be back in 5 minutes, okay? Please revise what we have discussed and then we'll continue. Okay, guys. So what is the answer to this one?
So both debt and equity.
No, guys. It's against equity only. Okay. PRs are against the equity. Okay. For debt, you can say there are
Sir,
foreign bonds. Yeah. Yeah. Any question?
sir, can I ask something?
Yeah. Yeah.
Sir, in the yesterday class, you talked with floating bond,
Your voice is
in
breaking.
which coupon part.
Your voice is breaking. Can you repeat?
Sir, is I am louder. In the
Yeah. Yeah.
yesterday told that floating bond also, floating rate bond, in which the coupon rate changes according to slave.
Okay. See, guys, what happens in case of floating rate bonds is we can say that okay, we are issuing you $1,000 face value, 3-year bond, annual pay bond, and the coupon rate would be equal to 10-year government bond yield plus 3%. So what would happen is whatever is the 10-year government bond yield, if it goes up, the coupon would go up. If it goes down, the coupon would go down. Got it? That's a floating rate bond that is dependent upon a benchmark. If that benchmark value goes up, it will go up and vice versa. Are we clear? So the coupon calculation will be done upon what is the 10-year government bond yield at that time plus 3%. Are we clear?
The interest is, sir,
Your voice is breaking a lot here. I'm not able to hear you. Yeah, please go
I
ahead.
think, sir, I
Yeah.
said in which interest risk is there or inflation risk is also there.
See, interest rate risk will not be there because it's the floating rate bond, right? But the inflation risk can be there that the inflation can be higher than the coupon you are getting.
Yes, sir.
Any other question, guys? Try this one.
GDR, sir.
Yeah, good. Okay, our next topic of discussion is going to be money markets, guys. So let's start that. Guys, what are money markets? How are they different from capital markets?
So it's a part of our financial market, capital market, money market in which treasury bills, certificate of deposit, commercial papers are traded.
Short-term instrument.
Absolutely, guys. Okay, so if the company, the government, if any bank wants to raise long-term money, they will try to issue shares. They will try to issue bonds. Okay, for more than 1 year. Yeah. Whereas if they want to raise funds for next 3 months or next 6 months only, they would not go to capital markets. They would go to money markets and try to use those instruments. Okay. We have various instruments in the money market, such as interbank lending, commercial paper, certificate of deposit, treasury bills, which we are going to discuss today. So these are the instruments which are used by the borrowers, such as corporations, governments, banks, etc., to raise funds for less than 1. Okay. Guys, when you talk about capital markets, those products can be exchange traded or OTC traded. Yeah, for example, equity is exchange traded, whereas some bonds are exchange traded, other bonds are OTC products. Yeah, whereas if you talk about money markets, it's all OTC products. Okay, these are not exchange traded products. All right, so let's start.
Sir, what was the volume of money market as compared to primary market?
As compared to primary market, primary market is that market where you are doing the IPOs or new bond issuances or private placements. That is primary market. Okay, not fair to compare these.
Okay.
All right. So money markets, guys. Why do we call them money markets? Because the funds are exchanged for a short period of time. It's like you are exchanging. It's the transfer of liquidity or transfer of money for a short period of time. That's why we call it money market. Okay. Some of the features of money markets are, guys.
Screen is not visible, sir.
Okay, sorry. First of all, short term. Okay. Second of all, there is no retail. Okay. For example, retail is there in the capital markets, but in the money market, you don't have retail participants. You don't have individual participants. You have institutes, companies, or the banks or the government would be dealing in these money markets. Retail participation is almost almost negligible. Okay, I mean, I would not say zero, but very less. So this is comparative. Okay, for example, in equities and bonds, we are still active, but we are almost inactive in case of money markets. Yeah? It's majorly a market which is dominated by institutes rather than individuals. Okay. Now, because institutes are dealing in this market, so the transaction sizes would be higher. Okay, so you will not have 1,000 rupees transaction or 10,000 rupees transaction, you will have the transactions in crores. Then you have less number of participants than retail market, than capital markets. Okay. In capital markets, you have a lot of retail participation also. So there are a lot of active involvement of buyers and sellers. Okay, but here you have less number of buyers and sellers, less number of participants, because only large institutes are dealing between themselves. So obviously the number would be smaller, but the transaction size would be bigger. Okay. Considered to be safe, okay, or you can say very less risky, because institutes are dealing, so we don't expect the institutes to default. Okay, so that's why, and banks are also actively involved in these money markets, and we don't expect banks to default, so we call it less risky, as most of the banks or large institutes are involved. Okay, and there is no central place, guys. There is no physical money market. It's an informal network where trading is done over the counter. Okay, guys, you will have various parties, such as you will have the lenders. Okay, you will have intermediaries, such as a central bank, the dealer, and then you would have the borrower. So there are three parties involved. The lender can be a corporation. The lender can be a bank. The lender can be a government. Can be a mutual fund. Can be a foreign institutional investor. Anybody. Okay. So anybody can invest. It can be retail also, but to a very small extent. Okay. And if we talk about, this is the intermediary through which you are dealing, and then there is the borrower. The borrower can also be corporation, bank, or government. Okay. So if corporation, any company wants, if any bank wants, if any government wants to raise funds in the money market for less than 1 year, they can raise them by issuing the money market instruments to the lenders through a central bank or a dealer. Okay. So these entities would You can say issue money market instruments okay, and they would get the money. Okay, guys, let me know if you have any doubt on this. If we are clear with this so far, can we go to the instruments?
Sir, I have a question.
Yeah.
Sir, in this, the intermediary is the central bank, but you said there is a OTC driven market, but there is a exchange in the like RBI
So
is
guys,
there.
first of all, there is no exchange involved, and by central bank, I mean central bank helps the government. For example, to central bank helps the government in issuing the bills and bonds for the companies. Okay. Similarly, there are dealers such as HDFC Bank and all, so you can go to them and buy the money market instruments.
Okay, sir.
Okay. So let's start with the money market instruments, guys. We have 4 money market instruments which we are going to discuss. First, let's start with interbank. Anybody heard of interbank lending?
Yes, sir.
What is it?
When the banks borrow and lend money from each other.
Absolutely, very good. Okay. So what happens in, as the name suggests, guys, it's happening between the banks. Okay. Let's suppose there is bank A and there is bank B. What they would do, they would exchange funds for less than 1 year. Okay. That is known as interbank lending.
So
Now,
can you?
yeah,
I just missed them. So can you?
yeah, I just said that it's interbank lending. It happens between the banks. Okay. So let's suppose we are in Mumbai. In Mumbai, you have, let's say, 20 banks of you. Many more, but let's assume there are 20 large banks which are there in Mumbai. Okay. So what can happen is they can exchange the funds between themselves for a short period of time. Okay. Guys, what the banks need to do, okay, these are regulated entities, you know that, okay. For example, HDFC Bank, ICICI Bank, SBI, Axis Bank, Kotak Mahindra, all these are regulated by RBI. Okay. So what RBI says is that, okay, we need to be sure that we are in a very good financial position. Okay. So that no bank defaults, so that there is no panic in case of stressful situations. Okay. So what RBI does to ensure all this is to maintain a certain CRR, SLR ratios for the banks. Okay, so these are like the regulatory requirements which every bank which is registered with the RBI has to follow. Okay, they have to maintain certain ratios for their banks to make sure that there is no panic, there is no shortage of funds in case the depositors ask for their funds back. Okay. Now, while trying to maintain these ratios, guys, I hope you know about cash reserve ratio, statutory liquidity ratio.
Yes, sir.
Yeah. Okay. So when you are trying to maintain these ratios, it might happen that a certain bank has excess funds. Okay. Even after maintaining that ratio, they have a lot of money left. Whereas bank B finds that, okay, they don't have the money to maintain these ratios, they want funds. Got it? So somebody has excess funds and somebody wants funds. So what would happen? Bank A would think, okay, let me give my money to bank B, and bank B in return would give me the interest. Okay. So what would they do? They would lend out some money to the bank B, and in return, they are going to get their money back plus interest. Okay. So it's like they will be able to earn some returns on their excess money, and bank B is able to satisfy its needs of getting the this is interbank lending. This usually happens within the banks which are nearby each other. Are we clear, guys? Can we go ahead?
Yes, sir.
Now, within this, guys, there are various types in interbank lending. There is call money, there is notice money, there is weekend money, there is term money, there is intraday money. What do we mean by call money is that the lender, okay, see guys, he will be known as the lender and he would be known as what? Hey guys, what will you call bank P?
Borrow.
Very good. Yeah, I ask you simple questions, guys. You should answer quickly. So in this case, the funds are exchanged till the time lender callbacks the funds. Okay. So if it is a call money, if they have entered into the contract as a call money contract, then what it means is the lender can call back the money anytime. Okay. So there is no fixed time, there is no fixed date on which you need to repay the funds. Okay. The lender can just give you a call and ask for the money back. All right. In the notice money, what happens, guys? Exchange the funds for 2 days, 2 weeks. Okay. If you are exchanging the funds for a defined period, that okay, we are exchanging it for 5 days exactly, or we are exchanging it for 13 days exactly. In that case, you would call it the notice money. Weekend money, what would happen is you borrow on Friday, you keep it for the weekend and return on Monday. Okay? That's the weekend money. In term money, the lending happens from 15 days to 65 days. That's when we call it a term money. And intraday money is like you borrow in the morning and return by evening. Okay, guys, are we clear?
Yes, sir.
Okay, try this question, please. Okay, calculate the interest to be paid.
Sir, 1.70 is right, sir.
Nobody got- That is not correct. Okay, my son is making a lot of noise. Sorry for that. Guys, the answer is not 191, I think you said, right?
So 1,43,750.
1,46,945. How would you do it is you have to calculate the actual. What is the actual number of days?
90.
92 days.
92 days.
92.
Okay. So your calculation interest that needs to be paid would be equal to 10 million into this is
Sir, 5.29.
per annum, guys. So what you will do 5.75% into 92 upon 360. This would be the exact calculation, which would give you
5.29.
this would be. Please try this now. Once you get the answer, guys, please confirm. Okay.
Yes, sir.
Done. Good.
Yes, sir.
146944 point. Like around this.
Absolutely right.
Sir,
And
146,945.
what if I say that the calculation would be done on this basis? Then what would be the interest?
1,44,931.
Absolutely. Then the interest. So what is the day count convention that would be followed? That would be mentioned when the two parties are exchanging the. I hope you are clear on this, guys. Now coming to advantages of this market. Can you think of the advantages of interbank lending?
Sir, high liquidity.
Okay, why do you say that?
Sir, there is a short-term period so in which so many transactions are there, so that's why.
Yeah, guys. For example, in call money, you can call back the money anytime. Okay. So basically, what is happening? You are giving the funds, and very soon you are getting it back also. Okay. So it's not your funds are blocked for a long period of time. So that's why we say high liquidity. Okay. There are enough banks which are ready to lend the funds, and there are banks who want the funds. So there is a borrower, there is a lender, and the funds are being exchanged for a short period of time. That's why we say we have a high liquidity.
Easy transferability has also.
Not really. Okay, you cannot transfer. Okay. For example, if you have borrowed money from somebody, you cannot transfer it to the third party.
Sir, low cost transaction.
Sorry.
Low cost transaction.
Low cost transaction. Okay, yeah. There's this, the transaction costs are low because there is no intermediary involved. Okay. For example, there is no broker involved. The two banks can call each other and exchange the funds between them. Nobody is in between them to charge the brokerage and all. Getting it? What else, guys? Any other advantage?
So it helps the banks to maintain their
Yeah.
their CRR and SLR.
Whatever regulatory requirements you need to meet, the bank which is falling short of funds can meet those requirements because of this market. Okay, so that's the advantage. And somebody who has extra funds can earn returns on those funds. What else?
Sir, can you repeat return on surplus once again?
Yeah, for example, we discussed, right? This bank has excess funds, right? So this bank can earn returns on those excess funds.
Okay, sir.
Okay, and guys, it also helps the regulator. It also helps the central bank in looking after the money supply in the market. Okay? For example, what will RBI do? It will check out, okay, there are so many borrowers, there are so many lenders. So they will try to figure out, do we have a lot of borrowers? Yeah, I mean, that indicates that banks are feeling short of funds, right? And if we have too many suppliers, but there are not borrowers, so that means banks have a lot of extra cash with them. Okay, so they can adjust their monetary policy. They can, you can say, direct the money supply by looking at the funds available with the banks. Okay, if the banks are falling short of funds, they will reduce the CRR, they will reduce the SLR. But if they feel that the banks have a lot of extra funds with them, they might try to reduce the supply by increasing the CRR and SLR ratios. Okay, what are the disadvantages, guys? First of all, it is very uneven development. Okay? Now, what do we mean by uneven development is, in every city, this market will not be active. Okay, for example, let's say you go to Kanpur. Okay, in that market, interbank lending will not be something which is happening. Okay, you go to a smaller market like Jaipur, in that the interbank lending might not be happening. Okay, but if you go to a bigger market like Delhi, Kolkata, Bangalore, Mumbai, in that interbank lending will be active. Okay, so in Mumbai, the banks will be exchanging the funds, but in Kanpur, that may not be happening. Okay, or it would be happening at a very, very small level. Yeah, so the development is not even. Okay, then you have lack of integration. That means, let's say it's happening in Mumbai, then it does not mean it will help out Bihar also. Okay, so there will be no integration between the banks in Bihar versus the banks in Mumbai. Getting it? So if it is happening in Mumbai, it will be happening within Mumbai only. There is lack of integration between the regional or local region specific markets. Okay. And guys, there is volatility in rates. Why? Because it's between the parties. Okay, so if you talk about at what rate the loan would be given to the other party, the funds would be exchanged, what is the interest that needs to be paid, that can be different in Delhi, that can be different in Mumbai, that can be different today, that can be different tomorrow. So there is a lot of volatility in because this is not happening in the central place where everything would be seen, right? So there can be a lot of change in the rates. Yeah, please note it down, guys.
Sir, can call money can be identified as disadvantage?
No, why?
Bank doesn't have the money and the lender bank call out the.
See, that depends upon the bank. Now you don't go for call money. You go for notice money. You go for term money. Then it's not a restriction that you have to go for call money. Guys done?
Yes, sir.
Yes, sir.
Yes.
Okay. So let's do one thing, guys. Let's take a break here, and we'll regather and discuss about the remaining money market experience. Okay. We'll be able to complete the money market today. Okay. And guys, did I take the attendance yesterday?
No, sir.
Yes, sir.
Okay.
Yes, you did.
All right. All right. So let's meet after the break and get on. Okay. See you after. Okay, let's continue, guys. Okay, is everyone back, guys? Can we continue?
Yes, sir.
Yes,
Yes,
sir.
sir.
Yes, sir.
Yes, sir.
So the next instrument we have in the money markets is certificates of deposit. Now, these are issued by banks to raise money for short term. Okay. So if you think about banks, guys, how can they raise funds? Banks can get the money from different banks. Okay, one bank can get the money from different banks. We call it interbank lending. Yeah, the banks can get funds from RBI. Yeah, at the bank rate, at the repo rate. They can also get money from large corporates. How can they get the money from companies? By issuing certificates of deposit. So what happens here is the banks get the money from, let's say, Reliance. Bank can get the money from Reliance by issuing certificate of deposit. Sorry. And later on, bank would need to pay interest on the money which was initially borrowed from a large corporate. Okay, so what banks can do, they can issue certificates of deposit to large institutions, companies usually, and borrow some money from them for, let's say, 3 months, 6 months, 9 months, like that. Okay, and when the certificate of deposit matures, then they have to pay that money back along with the interest. Guys, please note, CBs are unsecured promissory note. Unsecured because there is no collateral given by the bank. Bank is getting the money, so it's like Reliance is trusting the bank that they would return the money. The bank as such is not depositing any collateral with the corporate to which it is issuing the certificate of deposit. It can be mutual funds, guys. It can be FIIs. Okay, so they are unsecured. There is no collateral given by the banks. Also, these are the promissory notes. You know what's a
Sir,
promissory?
HNIs are also included in this.
Yeah, HNIs can also go for this. See, HNIs have different needs, okay? I mean, it's not an instrument which is of particular interest to HNIs. Okay? They'll be more interested in equities or other products which are high returns, right? They are HNIs, right? They would not go for something which is offering a low interest rate and it is for 3 months or 6 months. Really, that is not their interest, okay? But anyways, these are promissory notes. So what is a promissory note? It's like the bank is saying, I owe you. Okay? So whoever is holding this CD certificate with them, yeah, whenever the maturity of that CD certificate comes, the person holding the CD certificate at that time can go to the bank and ask for the money from the bank. The bank has to pay it because it's a promissory note. Bank is saying, I owe you this much amount and I'll pay you on this date. Okay. They are issued at face value, guys. That face value plus interest. These are also negotiated instruments, guys. That means you can transfer them. Two parties can negotiate between themselves and transfer. So that means, let's say Reliance bought the certificate of deposits from HDFC Bank. Reliance could transfer them to, let's say, Dabur. So they can be sold in the market to the other party over the counter. Now Dabur would be able to redeem them from the bank. Please note it down, guys. If you have any doubt, let me know.
So basically, its time period is longer or shorter.
Time period would be between
Sir, it can be transferred to general public also or only the corporation?
not to the general public, okay? Because when a bank needs funds, would he need 10,000 or 1 lakh rupees? It would need maybe some 40, 50 lakhs or few crores, right? Would general public be able to buy?
Okay.
So next we have commercial paper. Okay, please be on mute, guys. When okay. Guys, commercial papers are also unsecured promissory notes. They are also negotiated instruments. But these would be issued by, mostly these would be issued by corporates. Okay? So companies would be issuing them rather than banks. Okay. If the bank needs some short-term funds, they will issue certificates of deposits. But if a company wants to raise some funds, maybe to meet some short-term expenses like paying salaries to the employees or general administrative or selling and marketing purpose, they need some funds for 6 months. After that, they are sure they are going to get the revenue, but they need some funds for short term. They can issue commercial papers to the investors. Investor can be anybody else.
Sir, they can issue to also preference shareholders.
Guys, we are not talking about diluting ownership. We are not talking about capital market instruments. We are talking about raising funds for 6 months. Don't issue preference shares for raising funds for 6 months. So please don't lose that objective what we are discussing. Okay, so let's suppose they don't want to dilute the ownership, they just want to raise funds for 6 months, they can issue commercial paper. Okay, these are also unsecured, there is no collateral given, it's a promissory note, these can be negotiated, that means one party can sell it to other. Whoever would be holding the commercial paper at the time of maturity would get the money. Okay, these are sold at discount and redeemed at par. Suppose it would be like sold for 90,000 and after 6 months get Guys, can you tell me two differences between certificates of deposit and commercial paper?
The certificate of deposit is not issued to the general public.
Certificate of deposits are issued by government, whereas commercial papers are issued by large corporations. And commercial
Certificate of deposits are not issued by government. Okay.
So certificate of deposit can be issued by
banks
both
and
corporates and
Banks, yes.
yes, sorry,
Okay, certificate of deposits are usually issued by banks,
banks.
whereas commercial paper are issued by companies. Okay, both are for short-term needs. In the certificate of deposit, they are issued at a face value, and at the time of redemption, you get face value plus interest. Whereas a commercial paper is issued at a discount and redeemed at par. Okay, so these would be the two differences.
Sir, in which interest is not there.
This is interest only. This 10,000 extra you are getting is like interest only.
Yes, sir. Okay.
Okay, I'll ask this guys. Please don't say they are the same. Unsecured promissory notes, negotiable. I know. I can ask what is the similarity and the difference between. So you have to be clear with me. Next, we have the repo agreements, guys. See, guys, in repurchase agreement, what you do, the borrower would give the government securities as collateral to the lender. This would happen in the repurchase agreement, but guys, the borrower is not selling the government securities. Okay. It is just lending the government securities to the lender for some time with an agreement to repurchase them back. Okay. So eventually the government securities would go to the borrower only. Yeah. And he would pay the what happens in repurchase agreement. Can anybody tell me, guys, what do you think from your understanding so far is the difference between a repurchase agreement and, let's say, a commercial paper or a certificate of deposit?
Sir, can you repeat once repurchase agreement?
Yeah. See what happens here. The borrower will lend some securities to the lender. Okay. Mostly these will be government securities, which would be given to the lender, and the lender would give the money. Okay. Later on, the securities would come back to the borrower, and the borrower will return the money along with the interest.
Sir, here collateral is given.
Yes, that is very good. Okay. Earlier, what was happening? You were not giving any securities, right? You were not giving any government bonds or government bills, right? What you were doing, you were just issuing a paper or document known as a certificate of deposit or commercial paper. Yeah. Were you giving any valuable instrument, valuable asset? Not really, right? You were just preparing a contract document and giving it to the lender. So there was no surety to the lender. There was no collateral. But here you are putting your government securities with the lender that, okay, I'm taking some money, but you don't worry, you get these securities. If I don't pay you back, you can use these securities to get your money. Okay? So these government securities are acting as a collateral for the lender so that the borrower does not default. Okay, so repo agreement would be popular.
Here,
Yeah.
so here borrower can be HNI also.
No, the borrower would not be HNI. Why would HNI need
Limited
to borrow?
corporation.
Huh? No,
Oh, sorry,
guys,
sir. Wrong.
borrower would be a bank, let's say. Okay, they want some cash, let's say. They don't have the cash, but they have the government securities, and they don't want to sell the government securities. Okay, so what they would do, they would just keep the government securities with the lender as a collateral and get them back later. Okay.
The duration, what was the duration of
Within 1 year. Okay, it would be negotiated between the two parties, and these repo agreements would be more popular when there is a liquidity crunch in the market. These would be more popular when there is a liquidity crunch in the market. Then the lender, before giving you the liquidity, would definitely ask for some protection, right? So these would become more popular in that. When everybody has a lot of money, has a lot of liquidity available with them, they may not ask for collateral. Right? But if there is a shortage of funds in the market, then whoever is giving funds away would ask for some protection. Right? Okay. Are we clear so far, guys?
Yes, sir.
Yes, sir.
One more concept, guys. There is a concept of haircut. In graphite. What is this? What happens is, so it is very much the same. I'll add a couple of things to make it complicated for you, okay? So what happens here is, guys, not only this, but you have to give a certain margin or haircut to the lender as well. Okay, and what would lender return is the collateral you have given plus the rate. So you get it back, but you have to deposit a haircut also. Okay. So what happens is, guys, let's say the borrower wants $300 million. The borrower wants $300 million. So what would lender say? Okay, please give us government securities which are currently worth 300 million. Okay. So give us this plus also give us, let's say, $3 in cash. Okay. If you give these two things to us, then only we'll give you $300 million in cash. Sorry, this will not be 30, this will be 30. Okay, and at the end, lender would return that back, the government securities which you gave to the lender, plus the 30 million cash would be given back to the borrower, and the borrower would need to pay $300 million back plus interest on that $300 million.
Sir, is it necessary for the securities to be government securities or it can be any other securities?
It can be other securities. It is between the two parties. Okay, so whatever they agree for, but usually it is government securities.
Okay, sir.
Okay, guys, this is what you call as haircut or margin. Okay, it would be decided between the two parties. What do they exactly want? Here we have taken 10% haircut, right? So whatever money you need, 10% of that you need to deposit as cash with them. That has to be in the form of cash, guys. Okay, you cannot give $30 million of government securities also. Okay, so basically, if you think from the borrower perspective, they have to give 300 million worth of securities to get $270 in cash, right? Are we clear, guys? This is known as
Yes, sir.
some more terms. Repo loan in this case is 300 million. The haircut or margin is 10%. Collateral is government security. Okay, guys, like I asked you this, can you tell me this?
So there is no margin in repurchase agreement.
Yeah, guys, the main difference is this is like a secured loan. Okay, this is a secured instrument. Here you have a collateral. Okay, whereas these are unsecured. There is no collateral. Okay, there is a concept of haircut or margin here. There is no concept of haircut or margin. Please go through this, guys. If you have any doubt, let me know.
Sir,
Yeah.
sir, is there any benefit to lender, like they in future they have to return the security plus margin plus interest? So is there any benefit to lender in this?
Sorry, your voice is not very clear. I'm not able to get you properly. Can you please repeat?
Sir, in this repurchase, the lender has to return the government security debt to with interest. So is there any benefit to lender? Like,
Benefit is this. Benefit is that there is no risk here. You are getting the interest returns without taking the risk, right?
okay, sir. Okay, sir, got it.
Sir, I have a question related to LMS.
Okay, tell me.
Sir, I've logged in and found out that the due date is 13th, that is tomorrow. So it will not appear after tomorrow, or
Sorry, I did not get your question.
sir, the due date that is mentioned in LMS is 13th of August, which is tomorrow.
Hmm.
So after that, it is not accessible. The cash equity.
No. It will not be like that, okay? Just check with Damini once. Okay, if you face any problem related to not being able to access the LMS content, just reach out to Damini, ask her to take care of it. Okay, she will do it.
Through mail.
Yeah, drop a mail.
Oh,
But
okay.
there's the batch launch. Yeah, so you have to draft the proper mail. Okay?
Okay.
Sir, I have a question regarding the question.
Yeah, tell me.
Sir, in LMS there is a lot of videos, sir. The voice is so low, so I can't hear or listen or getting to the videos.
No, guys, I think the voice is decent. Maybe you can try out a different headphone or try out a more quieter place to listen to the videos. But I think the voice is decent, guys. I have also listened to the videos.
It will be more clearer if you
So I
use
put my
headphones.
earphone in the.
Okay, use headphones. Okay, um, use some decent quality headphones and sit in a quieter place.
Okay, sir.
Okay, any questions in what we have discussed so far?
No, sir.
Sir, what is reverse repo agreement?
Okay, see guys, what is the full form of repo? Repurchase. So who is repurchasing?
The borrower.
Okay, so from the borrower perspective, it is known as a repo agreement, and from the lender perspective, it is known as the reverse repo.
Okay, sir. Thank you.
Okay, let's go ahead, guys. Last one is our treasury bills. Treasury bills are issued by Treasury. Okay, so these are government. So treasury bills, treasury bonds are securities issued by the government to raise money. Okay, bills are issued for less than 1 year, so these are money market instruments. Bonds are issued for more than 1 year, so those are capital market instruments. Okay, so these are issued by central governments for their borrowing needs for less than 1 year. Okay, what happens? Government would reach out to RBI, and RBI would facilitate the entire process for the government. Okay, RBI is a government entity basically. RBI is acting on behalf of government only. So if government needs some funds, RBI would facilitate the transaction. Okay. So what RBI would do, they would issue T-bills to institutional investors and retail individual investors also. Okay. Some of the features are, guys, these are issued by central governments, right? The central bank. These would have a maturity of less than 1 year. Be issued at discount. Like commercial paper. Okay. Obviously, these are issued in the primary market through a competitive bidding process. Okay. So what happens, guys? There is a bidding process. Anybody aware about this? Anybody knows about bidding process?
Yes, in IPO there is also bidding process like this.
Okay, so there are two types, guys. There is competitive bidding. There is non-competitive. Okay, so what happens is if you want to subscribe to T-bills, you need to go through non-competitive bidding. Okay, or small investors can do non-competitive bidding. For example, in India, you have a platform of Go to Library. Check it out. Where you can use this application to apply for treasury bills, Okay. So what happens here is, guys, small investors would be placing their bids, okay, and they would definitely get the information. What would they do is they would mention the quantity. Let's say I say that, okay, I want 100 T-bills. Okay? I want 100 T-bonds. Okay, so I'll just mention the quantity and I can be sure that I'll get the quantity. I'll get 100 T-bills. So that's a non-competitive. I'm not competing against anybody. I'm just saying I want this and I'll get this. Okay, but this is a part of non-competitive bidding process. Okay, but there is a competitive bidding also, guys, that happens in case of large investors or institutional investors. See here, you will have a certain limit, okay, that all right, you cannot subscribe to more than 10,000 units. It has to be less than 10,000 units, but it has to be less than 1,000 bonds, whatever is the criteria. Okay? But let's suppose somebody wants to buy more than 10,000 T-bills or lot of T-bills, 2-3 lakh T-bills they want to buy. Okay, for example, institutional investor will not be interested in 1,000 T-bills, doesn't matter to them, right? So they would be looking at a larger quantity. So institutional investors would go through a competitive bidding process. Okay, they would not only mention the quantity, they would also mention the amount. Price, sorry. What price they want to buy, how much they want to buy, they will mention both. Okay. Now, every institutional investor would mention that what is the amount and what is the price they want to buy, right? So what would happen? The bids would be collected and they would be sorted in a manner lowest to highest yield. Okay, so yield is like your required rate of return. Okay, so whoever wants the lowest return that bid would be placed at the top, and whoever wants the highest return, that bid would be placed at the bottom. Okay, so guys, you are asking the institutional investors that, okay, you please mention the quantity you want and at what price you are ready to buy. Okay, so what you do, you sort the bids in a manner of lowest to highest yield or price. Okay, so whoever is ready to pay the highest price, that would be preferred in the allocation. Highest price means lowest yield, right? And lowest price means highest yield. Okay, so that would be sorted in that manner, and then the allocation would happen. Okay, so maybe not everybody would get the quantity here, unlike non-competitive bidding where you would get your required quantity for sure. Okay, so here you may get the T-bills, you may not get the T-bills based on the price which you have mentioned. Okay, are we clear with this, guys?
Yes.
So can you explain the sorted part again?
Explain the.
Sorted in a manner of lowest to highest yield.
Okay. I'll show you guys. It's difficult to explain like that. Just give me one second. See guys, what happens, that's how the bids would be sorted. Okay? We are talking about the competitive bidding process where different institutional investors A, B, C, D, E have placed their bids. Okay, so what is the institutional investor A saying? That okay, I buy a 1 million T-bill, sorry, at a price of 990. I am ready to pay this much to buy a T-bill, which is going to give me $1 million, let's say after 3 months. Okay, so it's effectively he's just ready to earn a return of just 10,000. He's happy with that much. So his required rate of return is just 1.01%. Okay, whereas B is saying, okay, I'll only pay this much. I want a return of this much. Okay, whatever is the difference between this and the 1 million will be the returns, and I need a return of 1.5%. Are we clear with this?
Yes, sir.
That's how you sort the bids. Okay. Now let's suppose they want to sell 4 million T-bills, 4 million worth of T-bills. Who would get the allocation?
A, B, C, D.
Sorry.
From A to D.
From A to D, right? Yeah. A to D is correct. Is everyone clear, guys? Let's suppose the government wants to issue 4 million worth of face value T-bills. Okay, so they will issue it to A, B, C, and D, right? Yes or no?
Yes, sir.
Okay. So based on that, there are some statistics. Okay. First is let's understand the stop yield. Stop yield is the maximum return at which the auction stopped. Okay. That means the allocation or the allotment stopped at D, right? So this is the stop yield and stop price. Okay. Stop yield and stop price are those yield and price at which the allocation stopped. Okay, average yield would be the average of all these yields which were selected. The bits which got selected, 1, 2, 3, 4, the top 4 bits, those average would be the average of all those 4. Okay, tail would be the difference between the average and the sum. So we can note it down, guys. Average would be the average of all the yields which are selected. Tail would be the difference between the average yield and the sum. Guys, are we clear? All these,
Sir,
okay. So what would happen? A, B, C, D would get the allocation, and every non-competitive bid would get the allocation. So you would see generally 80% of the issue would be subscribed through competitive bidding process, and 20% of the issue would be subscribed through non-competitive bidding process. Okay. Now, guys, at what price will everybody get the bills? Any idea? What price would A, B, C, D pay? What price would non-competitive bidders pay for every T bill? Any idea? So there can be uniform or discriminatory method. Okay. In uniform method, everybody would pay the same price, that is the stock out price. Okay. So what would A pay? 989, 900. What would B pay? 989, 900. What would C and D pay? 989, 900. Are we clear?
please
Yes,
repeat.
sir.
See, there can be uniform pricing method, or there can be discriminatory pricing method. Okay? So that in uniform pricing, what would happen? Everybody would pay the same price. So all A, B, C, and D are going to pay the same price, which is our stock out price. Simple, right?
Yes, sir.
Okay. What happens in discriminatory? Everybody pays the price they bid for. So A would pay 990, B would pay 989, 950, C would pay 989, 935, D would pay 989, 900. Clear?
Answer, non-competitive bidders, they will pay.
Good question. Guys, any idea about non-competitive bidders?
Sir, there is the quantity is fixed and non-competitive.
Sorry?
The quantity is fixed in non-competitive bidding process.
No, no, you can mention whatever quantity you want. It cannot be a huge quantity. Okay?
So you
If you
not
want a
sir, you
if you want a huge quantity, you have to go through competitive bidding process. But if you want a small quantity, then you can go for one. Are we clear? Okay. See, guys, non-competitive bidders would pay the weighted average price. They would pay the weighted average price based on competitive bids. Okay, so let's say there are 20,000 shares at this price, 30,000, sorry, bills, okay, not shares. 20,000 T-bills to be sold at this price, 30,000 T-bills to be sold at this price, 25,000 to be sold at. So what you do is you find out the weighted average price of the competitive bids which were selected. And that is the price which every non-competitive bidder has to. Okay. So guys, when you mention the quantity, the price would be decided based on the competitive bid. Yeah. So whatever is the weighted average price from the competitive bids which were selected, based on that, non-competitive bidders, all of them would pay the same price. Are we clear?
and quantity will be vary and the price should be weighted average.
Quantity you mentioned, buddy. Quantity you mentioned how much you want, right? The price would be dependent upon the competitive.
Okay.
Okay. Is it clear to everyone? Yes or no?
Answer,
Yes,
in
sir.
case of a uniform price, everybody will be paying the same amount. That is competitive bidders plus non-competitive bidders.
No. So what we are talking about uniform and discriminatory, it is only for the competitive bids. Non-competitive bidders would always pay the weighted average price based on the competitive bids.
Okay, sir. Okay.
Okay. Is everyone clear?
Yes.
Okay. I'll take your attendance, guys. Ashutosh,
Present, sir.
Nancy,
Present, sir.
Moksh,
Present, sir.
Parichai,
Present, sir.
Yogita,
Present, sir.
Anushka,
Present, sir.
Ridhi,
Present, sir.
Diksha,
Present, sir.
Rudraksh,
Present, sir.
Rezwa,
Present, sir.
Nasreen, Zeenat,
Present, sir.
okay. Nasreen is marked absent, okay? I hope Nasreen is not here. Nasreen, I can see you, but you are not speaking. Are you awake? In Nasreen, I am marking you present today, but you have to speak up, okay? Okay, guys. And I wanted to check with all of you guys. Are you fine in terms of the way we are studying? So is everything clear to you? Are you able to understand?
Yes, sir.
Yes, sir.
Yes,
sir.
No challenge, right? You're not
Yes, sir.
finding it too difficult. Okay, that's good to know, guys, because I'm checking this.
Sir, a little bit
was,
difficult.
difficult in terms of what? I mean,
Sir, as
in
I'm not
terms.
a commerce student, so I'm finding it difficult.
Okay, okay. No, so, okay, I'm talking about from two perspectives, guys. First of all, are we finding it technically difficult or are we finding it difficult because of online session? First of all, I want to check because we are having online session. So are you facing any problem because we are having online session?
Oh, sir.
Sir, offline would be better.
Sir, offline would be better.
Offline
Yes,
would
sir.
be
Offline
better.
will be better.
Okay. I mean, see, both has pros and cons, but as of now, as per the guidelines, we are waiting for the guidelines to start the classroom sessions. Okay. And once we have the guidelines, we'll start the classroom sessions as soon as possible. But that does not mean that we should compromise in any way. Okay. So that's what I'm checking is if you feel that if we are going fast or if you are not able to get something because we are having online sessions. See, I try to share the screen. I try to share on my screen everything which is important. But still, guys, if you face any difficulty, do let me know. Okay, if you feel that I'm going too fast or you need some more clarity or an example, we can discuss that. Okay, so first of all, I don't want anybody to face difficulty because we are having the online sessions. Secondly, guys, if you face any difficulty in terms of domain part, see, I can expect the non-commerce or non-finance background students to have some difficulty. Okay, that is very obvious. Suddenly, when you enter into try to do something new, it becomes difficult. Okay, if I try to learn French language, it will be very difficult for me, right? So that's okay. That's very natural. But guys, what you need to do is you need to put in that extra. Okay, I'm teaching the same way to the commerce and non-commerce student, and I am not going straight away to the hi-fi concept. Okay, I try to start from the basics and then build on that. Okay, I hope you are seeing that, guys. Yeah,
Yes, sir.
to explain from the very scratch. But still, guys, I can understand it would be difficult to start something new. So, guys, please put in that extra effort. And if you still face any difficulty, please come back to me and ask for help. Okay? Maybe you would have revised cash equities by now, or maybe by next Monday. That's up to you when you want to revise. But whenever you revise, you face any difficulty, please come back and ask me. I can help you out. If you don't ask me, I will not be able to help you. Okay, and you have to put in that extra
Can I
effort if
call?
you're not from that background.
Can I call for the doubts, sir?
Sorry, can I?
If there is a, can I call?
No, guys, taking doubts on call would be difficult, okay, because I usually have sessions or meetings going on. So it might become that I'm not able to respond and I'm not able to give enough time. But when we have the session, my all time is dedicated to you, okay? So use that time to discuss because I'll be free from other things at that time. So it will be easier for me and we'll have enough time to discuss also. Okay, so maybe
When
guys,
the Viva is going on.
yeah, you can ask when the Viva is going on, or guys, we can just do it like that. Let's keep the last 45 minutes for question and answers. If you want, we can do that, okay? Maybe, or we can keep one doubt session in between whenever you want, or we can keep the last half hour or 1 hour for just discussing the doubts. See, whichever way you feel comfortable, I'm fine with that. You should be satisfied with it.
As a Congress system, so what we do for
There is so much noise behind you. I'm not able to hear you properly.
So when will the Viva take place?
Guys, we'll have the Viva next week. Okay, most probably Monday or Tuesday.
Sir, level 1 is completed by the next weekend. Next week.
No, I think it will take 5-6 more sessions. Okay,
Okay, sir.
4-5 more sessions. So let's come back now.
Sir, main investment process is going on to the level 2 starting.
Yeah, in level 2, we'll be talking about the IB operations side. Right now, we are discussing various types of instruments or the products. Then we'll be talking about the operations in the investment.
So when is the Viva?
Monday or Tuesday, most probably Monday. Or Tuesday, guys. It can be on Tuesday. Okay. All right, guys, that's it from my side for today.
Sir, one student Zina drop a message here. She said, for
So
clarity,
Zina,
what material I study.
Okay, Zenith, don't worry about. See, you have a LMS portal in which you have all the. Okay, you have the PDF files, you have the PPT files, you have the videos. But I suggest you go through the class notes and class recordings for revision. Okay, because I am covering all the important points, so don't need to worry. Still, if you want more material, you can refer to LMS PPTs, LMS PDF, and LMS videos.
so where can we access the recordings?
Where can you access the recordings on the LMS? Or these recordings you are asking, you will get a YouTube link, guys, where these class recordings would be there, and you can check out the recordings from that YouTube.
Okay.
Okay.
So,
Yeah.
so I joined class today. So this is my name on the attendance list.
Okay. What's your good name?
Pravin Yadav.
Can you please drop your full name, your email ID, and your mobile number on the chat box to me?
Sure, sir. Sure.
But, uh, Praveen, you have joined today.
Yes, sir.
Praveen, I would request you one thing. You go through the recordings, okay, for the topics we have covered so far, and take some extra time out initially to cover up, okay?
Yes, sir.
It's going to be easy. It's not difficult. So once you have covered up, you will feel comfortable also, okay? Just, you will have the weekend now, yeah? I think we don't have any more sessions this week, right, guys? So you have 3 days, Praveen,
Yes, sir.
through the recordings. And if you have any doubt, you can ask me on Monday.
Okay, sir.
So please don't waste these 3 days, guys. I mean, critical for all, but Praveen, these are very critical for you. Okay?
Sure, sir.
All right. See you
Thank you,
guys.
sir.
Thank you.
Thank you, sir.
Thank you.
Thank you,
Thank you,
sir.
sir. Bye, sir.
Thank